think that what we have seen is a combination of a number of things. The first thing was we knew that valuations were very elevated. Reaction of stocks to a very good earnings season was quite subdued, and that already tells you that a lot has been already discounted. And the combination of rising inflation with a market that was buying into the transitory effect mentioned by the Fed and the low risk, etc. So it has created an almost perfect storm. There's an old saying in the buy side that says sell in May and go away. Well, in April we already had the high valuations, very optimistic estimates of growth and recovery, very optimistic views about monetary policy remaining extremely loose, even with rise in inflation. And suddenly the whole picture has been sort of rocked by a larger figure of inflation and more concerns that this may not be a short-term base effect as a few people were saying.
We see. I want to get to gold in just a minute. First, I want to start with the so-called digital gold. Bitcoin had a really tumultuous time the last few days or weeks. What do you think is happening here?
Cryptocurrencies are not immune to margin calls. And we need to understand that cryptocurrencies are extremely volatile. We have said it numerous times, you and I, and we need to understand that there's a thing called the law of gravity, that cryptocurrencies cannot just go up at massive percentages every year. What I find fascinating is that the same people that said that Bitcoin was a bubble at $7,000 are saying that it's collapsing at 38,000. So the what I'm trying to say is that we need to understand that these are startup currencies, that they are not reserve of value yet, that they are not yet real currencies with widespread utilization and that are accepted globally as units of measure. They're in the process, and that process is a bumpy one. It has always been. No, and they behave like very aggressive startup financial assets, very volatile.
We go to the real gold. It was probably the only asset that held up today. You think it's been performing quite well over the last couple of weeks. What do you put it down to?
Well, again, we have been talking for a while about the lack of logic of the weakness in gold in an environment of insane monetary policy, and because it was fundamentally financing very aggressive bets on the recovery and on very optimistic views about the global macroeconomic picture. I think that what is happening right now is a very quick unwinding of an aggressive short gold, long growth, long value stocks trade, no, that benefited from the combination of recovery and inflation, no. So I think that what we're seeing is that we are seeing I think that an interesting thing in markets right now is that bets are extremely concentrated. We have too many consensus bets, and once they reach very high levels of valuation very quickly. Gold is proven to be that asset that actually works in an environment in which the other risky assets, which are very correlated, equities, bonds, even cryptocurrencies, etc., when those roll over, gold does help as an asset that actually is decorrelated and that works as a reserve of value.
Work today at least, yeah. And the Fed minutes were probably no surprise to you that they weren't worried about inflation back in April. You think the markets are starting to price this in, that the Fed is still going to go hard with the monetary support?
Bond yields are showing that that markets at least perceive that the Fed and the ECB are going to continue with very aggressive loose monetary policies, even if inflation soars above the levels that we have seen in the first quarter. However, bond yields are also rising and spreads are widening. And I think that that is also a reflection of the fact that central banks can repress bond yields, but they don't work miracles. No, so I think that there is an element out there of excessive faith on what central banks can do, and at the same time a very dangerous bet that is betting on one thing and the opposite, which is, on the one hand, we see that there's a large consensus trade betting on rising inflation and faster growth, but at the same time betting on extremely loose monetary policy and very low rates. The two things don't go together. It's one or the other. And I believe that that is why we see such abrupt and quick changes in markets so quickly.
So where do you think we're going to end up?
In my opinion, the risk of stagflation is rising. In my opinion, we are seeing that a lot of the price rises that we see in the headline CPI, in the Consumer Price Index, are stickier than what the Fed is saying. Some of the commodities, etc. We are seeing, for example, that in many of the commodities that have absolutely no problem in terms of supply chains, the rise in price has been very correlated commodity index. So I think that the risk of a stickier inflation in an environment in which the optimistic views of fiscal multipliers and growth uh, is not something that we should not consider as impossible. So that is a risk that I'm watching, at least as a risk, not evident right now, but it could be a problem. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.